Welcome to Dr. Fred Markets. This is not financial advice. The gap between those who understand finance and those who don't is growing every year. Markets, crypto, artificial intelligence, they just require attention. You showed up today. You're on the right side of that gap. Let's make it count. Let's go.
You're betting on the Stanley Cup, but the real edge trades on weather. S&P down 2.6%, Nvidia faceplants 6%, gold bleeds 3.6%. Everyone stares at the screen like it's the burning bush. Meanwhile, a tiny, boring corner of finance is running a sportsbook on hurricanes, heat waves, and blizzards, and the house edge belongs to whoever understands odds better than Vegas. Signal 1. Sports betting volume has exploded to over $100 billion a year, but the average retail bettor eats a long-term loss of 5 to 10% because the odds are rigged by sharper math. The book survives because they're not predicting, they're pricing risk. They don't care who wins, they care the juice gets paid. Signal 2. Reinsurers and cat bond funds now sling over $100 billion in catastrophe risk. Markets where you literally get paid for the weather, not murdering an insurance company. Yields often sit in the high single digits to low double digits, and they didn't crash in 2008, 2020, or today, while Nvidia lost 6% in an afternoon tantrum. Signal 3. Regulated weather derivatives, futures and options on temperature, snowfall, rainfall, quietly sit on the CME like abandoned cheat codes. Power companies, farmers, theme parks, even ski resorts use them. Retail investors barely know they exist. That's the cliff edge. Sports fans lighting bankrolls on fire, while the same math silently prints for utilities hedging a hot summer. Here's the connection. You already understand the logic of weather derivatives if you've ever bet a game total. Over-under 5.5 goals in the Stanley Cup? Same structure as an over-under on 100 cooling degree days in July Dallas. You're not predicting a team, you're taking the other side of normal. Mechanism time. Forget drama. Think plumbing. Weather derivatives started because companies were sick of acts of God wrecking quarterly earnings. A warm winter nukes a gas utility's revenue. A cold summer screws an ice cream distributor. Instead of crying in earnings calls, they said, fine, we'll bet the weather. CME listed contracts like temperature futures, payoffs tied to average temps over a month's season in a specific city. HDD CDD indices, heating degree days, cooling degree days, basically how far temps deviate from comfy human laziness. Precipitation or snowfall swaps in niche OTC markets. They're structured like over-unders in sports. Under X degree days, one side wins. Over X, other side wins. No emotion, just math, hedging, or speculation. Now blend this with catastrophe risk, cat bonds. Insurer says, if a Category 5 hurricane smashes Miami this season, I'm screwed. Investor says, I'll take that risk for a 10% yield because my models say that storm's a 1 in 50-year event.
Does what you just heard shift something for you? That feeling, that need to know more, is exactly the right reaction. Most people never get there. You just did. Let's keep going.
If the storm doesn't hit, you pocket years of premiums while the S&P throws tantrums about Nvidia's multiple. If it hits, you eat the loss like a blown parlay, but at least you knew the odds before you sat down. Here's the one thing you didn't know. Historically, insurance-linked securities and cat bonds show near zero correlation to traditional markets. While your tech stocks whipsaw, your weather book just cares if nature behaves. This is diversification on God mode. Not more sectors in the same index, different universe of risk. Actionable for actual humans, not hedge fund goblins. Step 1. Learn the language. Read about HDD CDD, weather derivative CME, and insurance-linked securities funds. You're not trading tomorrow, you're learning why these exist. When you understand why they pay, you stop treating the market like a casino and start seeing balance sheets as betting slips on reality. Step 2. Look at accessible products. You're not wiring money into some Cayman reinsurance side pocket, but there are now listed funds and ETFs touching cat bonds and insurance-linked securities. Fees and risks are ugly but measurable. You're not trying to time hurricanes. You're deciding if 7 to 9% yield for weather risk beats praying to Nvidia's PE ratio. Step 3. Mentally reframe your portfolio. Slice your money into team risk and physics risk. Team risk, earnings, valuations, politics, hype cycles, Trump versus Ukraine votes, AI bubbles. Physics risk, hurricanes, heat waves, freeze events. The world's getting hotter, wetter, weirder. That's misery for homeowners, but pure order flow for weather traders. This is not financial advice, but here is the truth. Right now, most of you run 100% team risk and 0% physics risk. Then you stare at red candles and call the market rigged. The market is rigged in favor of people who price risk you're too bored to learn. So, here's your 3-point summary. 1. Sports betting and weather derivatives run on the same math, but only one pays institutions real diversification. 2. Cat bonds and weather trades don't care about Nvidia, Congress, or your favorite meme coin. They care about temperature and wind speed. 3. Your edge isn't predicting storms. It's realizing that being uncorrelated beats being right on direction. If you're going to gamble anyway, at least learn the markets where grown-ups price odds with physics, not vibes. Subscribe, because tomorrow I'll show you another part of the market where retail chases drama and institutions quietly farm boredom for yield. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.